NATO is alive and kicking. It means that we're going to see a clear increase in defense spending. This has to do clearly with the new US administration. I think it has to do with the fact that the European NATO members realized that they really have to increase and to step up their own defense efforts. Germany is really trying to lead by example for its European peers, but also for its NATO partners, indicating that it is willing to do whatever it takes in order to strengthen now its own defense.
NATO leaders are backing an increased spending goal on Wednesday. The Defense Alliance now wants members to spend 5% of their gross domestic product on security, but the deal won't apply to everyone. For more, we're joined by Carsten Brzeski, who is the chief economist at ING Germany. Carsten, what does this agreement mean?
Well, this agreement means that NATO is definitely not dead. I think that is what Emmanuel Macron said a couple of years ago, that NATO is alive and kicking. It means that we're going to see a clear increase in the defense spending. Well, you mentioned the 5% of GDP. These will be divided into 3.5% GDP really on military equipment and another 1.5% of GDP into defense-related infrastructure. It also, don't think that this is happening overnight. There will be a 10-year period in which NATO member states can then or have time to increase their spending up to these 5% of GDP. So which also means, yes, it will be a support to economies, especially to the European economy, but only over time.
This idea that the spending is broken down into pure defense spending and then this defense-related infrastructure, like you said, that jumped out at me. Was that a bit of a compromise to countries balking at this increase?
It was definitely a compromise because we had especially the Spanish government that was opposing the deal in the run-up to the summit, and I think there was a compromise to make it easier to also sell this agreement at home. But even there is some economic sense in all of this, because if it had been 5% of GDP only in defense spending, we would have probably seen many governments just trying to get everything under this umbrella and just trying to relabel certain expenditures. So by splitting it up already, by going from 2% of GDP to 3.5% on military and defense, I think this is feasible, and we won't get any kind of tricks, accounting tricks. And then 1.5% on infrastructure is clearly something that will also benefit domestic economies.
Also, this 5% figure, it doesn't seem to apply to all members. Who's exempt and why exactly?
Yeah, it's still a bit unclear on whether it's going to apply to all members or not. So the rumor is that Spain might be exempted, that Slovakia might be exempted. But I think we'll still really have to wait until the final statement by NATO to see whether in the end not all of them will really stand behind the 5% of GDP figure.
There are a lot of global events happening right now, but it seems like the news has been moving at a really rapid pace for months, if not years now. But, help us zoom out a little bit. Why is this defense increase happening now?
Well, I think that it has been under discussion already for quite a while. Why is it happening now? This has to do clearly with the new U.S. administration. I think it has to do with the fact that the European NATO members realized that they really have to increase and to step up their own defense efforts, and then bringing these things together also in terms of strengthening NATO. Is clearly what is behind this agreement right now. Because with the war in Ukraine, I think all NATO member states realize that they have to step up their efforts. With the U.S. administration, at least giving some indication that they are no longer willing to be this lender of last resort at any time and in any region, also means that other countries have to step up their military efforts.
Of course, speaking of the war in Ukraine, part of this is, of course, keeping up with an increasingly aggressive and combative Russia. I do want to hear from the Estonian Prime Minister, who was at the NATO meeting on Wednesday. Let's have a listen.
We need to ramp up our defense capabilities and defense industry, because if you look at the performance, Russia in 3 months is producing the ammunition that NATO members are producing per year. So that means that we need to ramp up our defense expenditure and industry.
So, Carsten, can NATO keep up with Russia's wartime economy?
Well, it has to. And just look at the size of the, if you would take all NATO member states together, look at the size of their combined economies. It is far bigger than the Russian economy. And even if the Russian economy now was shifted towards almost a full war economy, it is very easy for NATO member states to keep up with the Russian military efforts. But they only have to do it. And I think that now this announcement, this agreement to move from 2% of GDP to 5% of GDP in terms of military and defense spending, that is a clear signal that they have realized and that they're aware of the Russian threat, but also the need to do more. And if they now are really going to deliver, they would be easily able to not only catch up, but to clearly pass Russia in terms of military spending and also in terms of military equipment.
Let's turn to Germany specifically, because there was some defense news out of Berlin this week as well. The German government signed off on the country's draft budget for 2025 on Tuesday, and it paves the way for a massive hike in government spending. Carsten, what are you and I and all the other German taxpayers going to be getting for this big spending hike?
Well, we're hopefully getting better infrastructure and we're getting better defense. Because here I think Germany is really trying to lead by example for its European peers, but also for its NATO partners, indicating that it is willing to do whatever it takes in order to strengthen now its own defense. So we will get much more spending on defense. We will get more spending on infrastructure. Yes, this is an enormous fiscal stimulus. Yes, this will also increase over time German debt to GDP ratio from currently 60% of GDP to probably something like 80% of GDP. But if it's really invested in the right way, then it is clearly worth it.
You know, the times that we've spoken before, Carsten, a lot was made of the changes to the debt brake. There were fears, there were hopes, but has there been any fruit born of those fears or hopes?
Well, I think we're finally seeing a German government implementing fiscal stimulus. And I think this is really a watershed moment in German politics, but also for the German economy. The German economy has been suffering from underinvestment, from public underinvestment over more than a decade. This situation that we've had now a stagnating German economy for 2 years in a row is also partly the result, or to some extent the result, of this underinvestment. Germany has been running behind when it comes to infrastructure, digitalization, education. So it was urgently needed that we get a government that finally starts spending. So that's also why I wouldn't be too critical right now if we finally see the numbers. I think what the good thing about the new government clearly is that they are delivering on the promises that they made, not only during the election campaign, but clearly in the coalition agreement. So I think that is very positive if it is really implemented in the right way.
I'm wondering what you make of the cost of borrowing right now and the debt that's being incurred by the government, because it seems like this would be a better hand to play, so to speak, than the previous government had, because rates have been going down. Am I understanding that correctly?
Yeah, partly. We even, when you look back like 5 years ago, we even had negative interest rates. So that was the best time actually to engage in significant fiscal stimulus. The government back then didn't do it. So we've now had higher interest rates have come down a little bit. And clearly in terms of the costs of borrowing, this is still a a relatively good time for the government to engage in this debt-driven or debt-fueled spending program. So I wouldn't be too concerned currently about the cost, because we all knew if you say A, and A is Germany needs more public investment, you also have to say B, and B simply means yes, it will come at a cost, and the cost is higher debt, and higher debt will also eventually lead to higher interest rates, to higher borrowing costs. But I think this is the price that Germany currently has to pay, because the benefit would be that we have finally, or that we finally will get a competitive infrastructure again, that we will get a much stronger own defense industry, and that we will also hopefully catch up in terms of digitalization and education, which should make the German economy again more attractive for domestic and also foreign private investors.
Focusing in on the defense spending part of this draft budget, defense spending is set to more than double by 2029. Where is that money going?
Yeah, this money will initially probably be going into really the personnel, army, and then also in military equipment. Don't forget, we still are benefiting right now from the previous government's decision to increase defense spending from 1% of GDP to 2% of GDP. So we have this special fund that is still active currently till 2027. And then after 2027, we will see even more defense spending, which then will be financed through the annual budget. I think the challenge now will be that this defense spending will also go into domestic or at least European military industry. Because when you look at the numbers over the last couple of years, European procurement or European investments in military went for a large extent to non-European companies. So it is now clearly the challenge to channel these investments to the domestic companies, which will need time to build up production capacities, but which then also over time could become more of a growth driver for the entire economy if this defense spending continues.
That was exactly where my mind went, which is essentially, are German companies shifting gears, or are we seeing new companies sprouting up to provide the kind of material goods that the German company is apparently looking to buy? Is that shift already happening? Are you seeing it?
I'm compliance-wise not allowed to mention individual companies, but when you look at the stock market yourself, you will find a couple of very prominent German company names currently, having seen their stock prices rallying over the last couple of months. So there is clearly this fantasy that these German companies will benefit tremendously. And indeed, also when you look at the order book situation, there has been a big increase in new orders flowing into the military industry. So I think that is clearly something we're going to see continuing. The next question then will be for German industry, whether we could see, for example, suppliers in the automotive industry starting to diversify their production and also diversify out of the automotive industry into the military industry. And so this is something that we will probably also see over the coming years if, and I think that's the big if this commitment on defense spending, on higher defense spending, is really sustainable and longer lasting. And the final word is what we also know, at least from the US experience, the longer a country or an economy has a strong military industry, the higher the likelihood is that this also leads to more innovation, creativity that would then again in turn also benefit other sectors of industry. That is really something only for later on, not for the initial part, but for right now, for the next 1 or 2 years, I would clearly expect that the military industry in Germany and in Europe will grow. Final word, if you look at the size of the military industry right now in Germany, it accounts for roughly 0.5% of the total economy. So it is still a very small subsector of German industry.
Now, this year's budget was late because of the snap national elections that happened earlier this year. So debate and final approvals are still needed in the next few weeks and months. Are you expecting any changes?
Not really. I think I'm currently positively impressed by that this government is just normal. And I think this government is benefiting from the fact that they don't mess up. And I think they know that this is clearly one of, more of their unique selling points. So I think I'm currently seeing really a strong discipline within this government not to mess up. So this is why I would expect that this is almost a no-brainer. I wouldn't talk about month. I think that we will clearly see that Parliament will pass this budget already before the summer break, because this government really wants to show, and it has to show, that it is delivering and that it's really trying everything it can to kickstart the German economy.
Now, discipline in the first few months of this government is one thing, but are you noticing other priority shifts that are evident in the budget this time around?
Well, I think the other priority shift that I haven't seen that I would have liked to see is what about expenditure cuts? So when you look at the longer term projections in this budget, so you see that there is an increasing financing gap. If you just now look at this federal budget, this deficit would increase to something like 5% of GDP, and that is not including regional states. This is not including Social Security. So we're really looking into a future of a couple of years in which Germany will more than breach European fiscal rules. So what I would have liked to see in this budget is a clear path in the annual expenditures towards, at least towards more expenditure cuts, to show that we need this fiscal stimulus now over a shorter period of time, but that at the end of the ride, this government is willing to return to a bit more public finance stability or solidity. And that is something that we're not witnessing in this budget.
Carsten Brzeski, Chief Economist at ING Germany, thanks for joining us.
Thanks for having me.